Okay, let's unpack this. We've been handed a really fascinating stack of sources,
All drawn from a recent CFO presentation.
and it details the entire financial architecture of a technology-driven lending business.
Right, and it's dense stuff, but the mission here for you isn't really about the accounting.
No, it's about strategy. We need to understand how this deep integration of AI, of these dynamic models, fundamentally shifts the whole game,
The unit economics, the growth potential, all of it.
and help us see why this financial profile is, well, considered genuinely unique.
It's unique because they're not treating lending as just a distribution problem. They see it as a technical flaw that needs a technical fix.
And the presentation kicks off with a really powerful critique of traditional credit markets.
It does. It basically argues that the vast space of consumer credit is just, structurally mispriced.
And the analogy they use is incredibly clear, which is why it stuck with me.
What's that?
They say that every single borrower who is responsible, who pays back their loan, is essentially paying a tax.
A tax to subsidize strangers.
Exactly, the people who ultimately default.
And that's not a small thing. Since the majority of borrowers do pay back their loans, most of that risk pricing is actually overpricing.
Right.
What's fascinating here is that the sources highlight that this default subsidy, this penalty paid by the good borrowers, can be the single biggest component of the APR.
The single biggest.
The biggest. It's a massive structural penalty on the vast majority of credit-worthy people.
So we're not talking about a rounding error. This is the core business model of credit being inherently inefficient.
That's the pricing problem. But then there's what they call the process tax.
The process tax,
It's that grueling, friction-filled experience of applying for credit.
all the paperwork, the waiting.
All of it. And that friction exists because lenders need it to weed out a tiny minority who might try to commit fraud.
So because they couldn't accurately target that small group, everyone pays the price in time and effort.
Exactly. And what's wild is that the two biggest buying criteria in credit are price and ease of process.
And the industry, for decades, has failed on both.
Precisely. Which brings us to the first pillar of their strategy, using AI as the foundational solution.
This is where it gets really interesting for me. This company, they explicitly view their core mission as being technologists first.
Right. They believe better models are the clear, almost elegant answer to solving both of those problems at the same time.
They're not trying to win with a bigger marketing budget. They're trying to win with predictive accuracy.
And better modeling immediately addresses both sides of that equation. On the pricing side, you can reduce that default subsidy.
How so?
Well, instead of static FICO bands or simple rules, their models can evaluate hundreds of data points. This lets them get much better at identifying and avoiding defaulters.
And the direct result of that is?
Lower APRs for the majority of good borrowers who were previously getting overcharged.
Okay, so lower prices attract more customers. Makes sense. But what about the friction? How do the models make the process easier?
That comes right back to the process tax. Since the models are so good at flagging that tiny minority of bad actors, the company can hyper-concentrate the friction. Meaning they can put all the heavy manual verification steps only on that tiny high-risk group.
Which allows the other 90-something% of applicants to just sail through.
To run fast and free, as they put it. A near-instant, seamless digital experience.
And this philosophical commitment is just. It's fundamental. The source is making clear this isn't some side project.
Yeah.
They state their core credit committee is an AI model. They say they don't believe in doing this half-baked.
It's an architectural commitment. It's not just machine learning optimization. It's using predictive tech to totally restructure the product.
Which raises an important question for you, the listener. In a world obsessed with AI monetization, how do you turn models into profit? Well, this company offers a clear path.
Use better predictions to directly improve the core value proposition in a massive, inefficient industry. That is an immediate, measurable competitive advantage.
So if they've used tech to fix the core economics of the product, the next question is how does that change their ability to scale?
Right, which leads straight into their unique growth model.
And historically in lending, rapid growth was viewed with, well, a lot of skepticism.
Intense skepticism. Because without differentiated underwriting, you were stuck between two terrible choices.
You either ramped up marketing costs, which killed your margin,
Or you opened the credit box, which risked catastrophic losses. Both were unsustainable.
but if your underwriting is dynamic, that terrible choice just disappears. And I think we should spend a moment on dynamic underwriting.
Definitely. It is the engine of the whole growth model.
So what does it mean?
It means the model is constantly learning and improving based on the performance of every single loan it originates.
And as the model gets better,
It reduces that default subsidy, which, as we said, immediately improves the APRs for good borrowers.
better rates.
Yeah.
And the direct result of offering better rates is what?
A higher conversion rate. More people who see the offer actually take it.
So rapid growth isn't a red flag signaling high risk anymore.
No, it's a direct, measurable consequence of a technological breakthrough, a model improvement. The sources even show that their big growth spurts map almost perfectly to reported gains in conversion.
It's a direct feedback loop.
Exactly. And the long-term strategy shifts. It's not just about conversion, it becomes about sheer volume.
What do you mean?
Once the conversion rates get high enough, the model gains let them spend more on marketing to just grow the top of the funnel. Because that funnel is so productive, they end up with more loans at flat or even declining acquisition costs.
It's a system that's designed to accelerate.
That is a phenomenal flywheel.
Okay, let's talk about margin and control over pricing. The take rate.
Right. If you're running on static, rules-based underwriting, you're a price taker. Everyone can pretty much price risk the same way.
But when you introduce differentiation,
You can perceive hidden value in parts of the borrower base, value that the legacy market just doesn't see or correctly price.
and that perceived hidden value translates directly into pricing power.
Price and elasticity, yeah. The better the models get, the more pricing control they have.
That's the theory. Where do the numbers in the presentation back this up?
This is where it gets kind of startling. The sources show that for borrowers they really like, those the model sees as low risk but the market overprices, they found a lot of room to raise take rates.
How much room?
They cited increases anywhere from 40 to 60% on certain segments.
Wait, 40 to 60% increases in their take rate, and they can still offer the best product on the market.
They can. Because the legacy systems are so inefficiently priced, their underwriting might identify a good borrower and say, okay, 12% APR. The market, with its default subsidy, might be charging that same person 18 or 20%.
I see.
So if this company raises their rate to, say, 14%, a huge take rate increase for them, they're still offering that customer a significantly better deal than anyone else.
So they are fundamentally not price takers.
Not at all.
That control over the revenue side takes us right into the cost side. Margin expansion and operating leverage.
Right. If you connect this to the bigger picture, this differentiated tech allows for significant profit margin expansion, not just high revenue growth.
Okay, so let's break down the cost advantages.
First, you've got variable costs, especially operations. Good verification and fraud modeling lets them automate more and more.
Taking manual human work out of the system.
Exactly. As automation rates go up, those costs go down. That's a key driver of margin expansion.
And second, acquisition costs.
Which we touched on. The dynamic growth model lets them scale without that typical lending penalty where finding the next customer is always more expensive.
They've shown they can scale at flat to declining acquisition costs.
Which is almost unheard of in competitive financial services.
So, increasing take rates on the revenue side, decreasing operations costs, and flat acquisition costs on the other.
The result is demonstrable margin expansion. The sources showed their contribution margins expanding from the mid-40s to the mid-60s over time, in a fiercely competitive space.
But they were careful to note that their ultimate goal is maximizing contribution dollars, not just the margin percentage.
That's a critical distinction.
Why?
It is. They'll launch new products that might temporarily dilute the margin percentage. The profit ratio might be lower, but those products are still accretive to total contribution dollars.
So they want to maximize the total pot of money they make.
Right. It shows a long-term focus on volume and market share over just pure ratio optimization.
And because of where they invest, they also get significant operating leverage.
Yeah, they note that more than half of their salaried headcount is in the technology organization.
A direct reflection of their R&D investment, not manual servicing or branch infrastructure.
They even track a software business heuristic, which is highly unusual for a lending platform.
What's that?
They aim for roughly $1 million of annualized revenue per salaried headcount. That level of productivity is just astonishing.
That's a software metric, not a lending metric.
Exactly. It shows the investment in R&D is becoming leverageable. They're transforming what's traditionally a labor-intensive cost structure into a highly efficient fixed software cost structure.
So when their top-line revenue grows,
Those dollars fall very efficiently to the bottom line, which they track through EBITDA margins.
Which brings us to the final piece. Their long-term vision for profitability and a low capital intensity model.
Their approach to profit has always been a little unusual. When they were a private company, they prioritized growing with GAAP profits.
Generally accepted accounting principles.
Right. And they said this was considered weird by venture capitalists who just wanted raw growth at all costs. But for them, GAAP profits meant they were growing sustainably.
And that priority continued when they went public.
For sure. They were GAAP profitable for their first 6 quarters post-IPO. Very rare for their fintech cohort. And while the last couple of years have been challenging, they've maintained that priority, guiding for a return to GAAP profitability soon.
But crucially, they want to do all of this in a model of low capital intensity.
This is maybe the most defining strategic choice. They state clearly they have no intention of becoming a bank.
Why not?
Because they realize their ambitions for scale and velocity would be fundamentally limited if they had to furnish all the capital themselves.
And we want to be the software layer, the brain, but not own the factory floor, the balance sheet.
Precisely. It's the lending world's version of an asset-light model.
So where does the capital come from?
They rely on a deep network of partners bringing third-party capital to the platform. They are focused on generating fee revenue and servicing income, not net interest income.
And their own balance sheet, what's its role?
It's strategic. They use it as a tool to launch and incubate new products quickly.
Okay.
And to co-invest with partners, to show they have skin in the game. It's a model built for maximum agility and scale. The value isn't in owning the debt. The value is in having the superior prediction engine that identifies who should get it.
So what does all this mean for you? This deep dive shows that technology here is not some auxiliary feature. It's not a marketing bolt-on.
No, it is the engine.
The engine that creates this unique financial profile, it allows for rapid growth without compromising credit performance.
It generates substantial margin expansion in a hyper-competitive market.
And it maintains capital efficiency by externalizing the balance sheet risk. It's a complete re-architecture of the traditional lending model from the ground up.
And if that technology allows a company to perceive hidden value that the market doesn't appreciate, and if their models are constantly optimizing for long-term customer relationships, not just the next transaction, well, this raises a pretty important question for you to consider.
Which is?
How does this model fundamentally change who gets access to credit? And maybe more importantly, how quickly can legacy lenders, constrained by decades of rules-based systems, ever hope to catch up with a company whose core product is powered by an endlessly learning AI?